If you are retired, close to retirement, or planning to retire in the next few years, there's something important you need to know. 2026 is bringing several retirement rule changes that could affect your money, your taxes, your saving strategy, and the way you plan for the future. Some of these changes may help you keep more of your retirement income, while others could create expensive mistakes if you are not prepared. The biggest problem is that retirement rules are not always explained in a simple way. Many Americans spend decades working, saving, and contributing to retirement accounts, but when they finally reach retirement age, they discover there are rules they never knew existed. A small mistake with withdrawals, taxes, Medicare costs, or required deadlines can sometimes cost retirees thousands of dollars over time. Today, we are going to break down the most important retirement rule changes you should understand in 2026. We will talk about what is changing, who could be affected, and the mistakes you need to avoid. Whether you are already receiving Social Security, managing a 401k, using an IRA, or preparing to leave the workforce soon, these updates could directly impact your financial future. Before we begin, remember one important thing. Retirement planning is not just about how much money you saved, it is also about understanding the rules that control how that money works after you stop earning a paycheck. Many retirees spend years building their nest egg, but protecting that money requires staying informed. Let's start with the first major retirement change that many Americans need to pay attention to in 2026. The first area is retirement account withdrawal rules, especially for people with traditional retirement accounts like 401ks and IRAs. For many years, retirees have had to pay close attention to something called required minimum distributions, commonly known as RMDs. These rules determine when certain retirement account owners must begin taking money out of their accounts. The reason this matters is simple. Many people spend their entire working life putting money into retirement accounts and watching it grow tax deferred. But eventually the government requires those withdrawals because taxes have not yet been paid on that money. A lot of retirees make the mistake of thinking, this is my money, so I can leave it alone forever. But retirement accounts like traditional IRAs and 401ks come with rules. Ignoring those rules can lead to unnecessary taxes and penalties. Imagine a retiree named David. After 35 years of working, David built a comfortable retirement account. He was proud that he didn't need to touch it immediately after retiring. He believed leaving the money invested was the smartest choice. But because he didn't pay attention to retirement distribution rules, he missed an important deadline and created a stressful tax situation that could have been avoided with simple planning. The lesson here is not that retirement accounts are dangerous. In fact, they are powerful tools that help millions of Americans prepare for retirement. The lesson is that every retirement account has rules, and understanding those rules is just as important as saving the money itself. The second major change seniors need to understand in 2026 involves tax planning during retirement. Many people assume that once they retire, taxes become much simpler. They think, I'm no longer working, so my tax problems are over. Unfortunately, retirement income can still create complicated tax situations. Your income may come from several different sources: Social Security, retirement accounts, pensions, investment income, or part-time work. The combination of these income sources can affect how much you owe and how much money you actually keep. For example, two retirees could have the same total income, but very different tax situations depending on where that money comes from. One person might withdraw strategically from different accounts, while another might accidentally create a higher tax burden by taking too much from one source at the wrong time. Think about Susan, who retired at age 67. She had Social Security income and a traditional IRA. Every year, she simply withdrew money from her IRA whenever she needed extra cash. She never thought about how the timing of those withdrawals affected her taxes. Later, she learned that with better planning, she could have managed her withdrawals differently and potentially reduced the amount of taxes she paid over time. This is why many financial experts emphasize that retirement planning does not end when you retire. In many ways, it becomes even more important because now every decision affects money you may need for decades. The third major retirement change in 2026 involves Social Security and the way retirees think about their overall income strategy. Many seniors view Social Security as their entire retirement plan. For millions of Americans, Social Security is a critical source of income. But one mistake many retirees make is assuming their Social Security check alone will automatically keep up with every rising cost. Inflation, healthcare expenses, housing costs, and everyday expenses continue changing. A retirement plan that worked 5 years ago may not work exactly the same today. For example, imagine someone who retired in 2020 with a carefully planned monthly budget. At that time, their Social Security check covered their basic expenses comfortably. But several years later, grocery prices increased, insurance costs changed, and medical expenses became higher. The income stayed relatively predictable, but the cost of living changed around them. This is why reviewing your retirement plan regularly is so important. Retirement is not a one-time decision. It is an ongoing process that requires adjustments as your life and the economy change. The fourth retirement rule change you need to know about in 2026 involves Medicare costs and healthcare planning. Many retirees focus heavily on their Social Security amount, but forget that healthcare expenses can significantly affect their retirement budget. Medicare premiums, prescription costs, supplemental coverage, and out-of-pocket expenses can all influence how much money you actually have available each month. A retiree may receive an increase in income but still feel financially pressured if healthcare costs rise at the same time. This is why understanding the relationship between Medicare and retirement income is extremely important. Consider a retired couple, John and Linda. They planned their retirement carefully and believed they had enough monthly income. But as they got older, healthcare expenses became a larger part of their budget. Because they had not planned for those increases, they had to make difficult adjustments later. The important lesson is this: retirement planning is not only about saving money. It is about preparing for the expenses that often increase the most as we age. And we are only halfway through the most important retirement changes coming in 2026. The next updates involve decisions that could directly affect your retirement savings, including changes around investment choices, protecting your money from inflation, and mistakes that could reduce the amount of money you keep during retirement. Because one of the biggest retirement mistakes people make is not losing money through a bad investment. It is losing money because they do not understand the rules surrounding the money they already have. Now let's continue with the next retirement changes that could affect your money in 2026. These are the areas where many retirees make mistakes, not because they are careless, but because retirement rules can be complicated and most people never receive a simple explanation of how these decisions actually affect their future. The fifth important retirement change involves how you manage your retirement savings during periods of inflation and economic uncertainty. For many retirees, inflation is one of the biggest financial concerns because they are no longer earning a traditional paycheck. When prices rise, workers may have opportunities to increase their income over time. But retirees often depend on fixed sources of income, which means rising costs can put more pressure on their savings. This is why 2026 is a year where many retirees need to pay closer attention to how their retirement money is positioned. The goal is not to chase risky investments or make emotional decisions based on daily headlines. The goal is to understand your financial situation and make sure your retirement strategy matches your needs. Imagine a retiree named William. After decades of working, William saved carefully and believed he was prepared. But when inflation increased, he noticed that his monthly expenses were slowly taking a larger portion of his income. He became worried and started looking for quick solutions online. He found advertisements promising guaranteed returns and inflation-proof investments that claimed retirees could protect their money without any risk. The problem was that these offers were designed to create urgency. They told him he needed to act immediately before the opportunity disappeared. Fortunately, William took time to research before making a decision. He realized that many of these offers were not designed to protect retirees. They were designed to take advantage of retirees who were afraid of losing purchasing power. This is an important lesson for everyone approaching retirement. Whenever someone promises high returns with no risk, guaranteed profits, or a secret strategy only available for a limited time, be extremely careful. Inflation creates fear, and scammers know exactly how to use that fear. The sixth retirement change in 2026 involves protecting your retirement accounts from unnecessary mistakes. One of the biggest problems retirees face is not always a lack of money. Sometimes it is making a decision without understanding the long-term consequences. For example, withdrawing too much money from retirement accounts too quickly can create tax problems. Taking money out during a market decline without a plan can permanently reduce your savings. Ignoring account statements can allow mistakes to continue unnoticed. Many retirees spend years carefully building their retirement accounts, but after retirement, they stop paying attention. They assume the hard work is finished. But retirement is actually the stage where your decisions become even more important because you are now using the money you spent decades creating. Think about Margaret, who retired after 40 years of working. During her career, she checked her retirement accounts regularly because she wanted to make sure she was saving enough. But after retirement, she stopped reviewing them because she thought there was nothing left to do. Several years later, she realized her withdrawals were not matching her original plan. She was taking slightly more than she needed, and small changes in expenses had affected her long-term outlook. Once she reviewed everything carefully, she was able to make adjustments and feel more confident about the future. The lesson is simple. Retirement accounts should not be ignored after retirement. They need attention, just like any other important part of your financial life. The seventh important retirement change involves understanding new opportunities created by updated retirement rules. Every year, retirement laws and regulations can change. Some changes create new opportunities for people to save, contribute, or manage their money differently. The challenge is that many people never hear about these changes because they assume retirement rules only matter while they are working. But the truth is, Retirement rules continue affecting you long after you leave your job. For example, changes related to retirement accounts, contribution rules, withdrawal options, and tax planning strategies can create opportunities for some retirees and challenges for others. The people who benefit the most are usually the ones who stay informed and review their plans regularly. Think about two retirees who both worked for the same company for 35 years. One person continues learning about retirement updates and reviews their strategy every year. The other person simply keeps doing what they did when they first retired. Over time, those small differences in awareness can create a major difference in financial confidence. The eighth important retirement issue in 2026 is something that has become more important than ever: protecting yourself from retirement scams. Whenever new retirement rules, government programs, or financial changes are announced, scammers immediately look for ways to take advantage of confusion. You may receive a phone call from someone claiming to be a retirement specialist. They may say they can help you unlock hidden benefits or protect your savings from new rules. They may ask for personal information, account details, or payment for their services. But remember this: legitimate organizations do not pressure you into making immediate financial decisions over the phone. They do not demand your private information just because they contacted you first. A common scam today involves fake financial advisors who promise to move your retirement money into a safer account. They often use professional language and create a sense of urgency. They may even provide fake documents that appear official. Before making any major retirement decision, slow down. Talk to someone you trust. Verify information independently. A legitimate opportunity will still exist after you take time to research it. Now let's talk about the ninth and final retirement rule change that could affect your money in 2026. This one is about something many retirees underestimate: having a retirement plan that can adapt to change. Many people create a retirement plan based on one moment in time. They estimate their expenses, choose when to retire, decide when to claim benefits, and assume everything will stay the same forever. But life does not work that way. Your health can change. Your family situation can change. Your expenses can change. The economy can change. Retirement planning is not about creating a perfect plan that never changes. It is about creating a plan that can adjust when life changes. Imagine someone named Robert. When he retired, he had a clear plan. His savings, Social Security, and expenses were all balanced. But 5 years later, his situation looked completely different. Healthcare costs increased, his home needed repairs, and his financial priorities changed. Because Robert reviewed his plan regularly, he was able to make adjustments before problems became overwhelming. He didn't wait until there was a crisis. He adapted early. That is one of the biggest differences between retirees who feel confident and retirees who constantly feel worried. Confident retirees are not people who have perfect financial situations. They are people who stay aware, review their options, and make adjustments when needed. So let's summarize the major retirement changes and lessons you need to remember in 2026. First, understand retirement withdrawal rules and avoid missing important deadlines. Second, pay attention to taxes because retirement income can still create tax responsibilities. Third, remember that Social Security is only one part of your retirement strategy. Fourth, prepare for healthcare costs because they can significantly affect your budget. Fifth, protect your savings from inflation by avoiding emotional financial decisions. Sixth, continue managing your retirement accounts even after leaving work. Seventh, stay informed about retirement rule updates that may create new opportunities. Eighth, protect yourself from scammers who target retirees during times of change. And ninth, keep your retirement plan flexible because life rarely stays exactly the same. The biggest retirement mistake is believing that the work ends when the paycheck stops. In reality, retirement requires a different kind of attention. Instead of building your wealth, you are now protecting it. Instead of planning for the next promotion or career move, you are planning for decades of financial security. You work too hard to spend your retirement years worrying about mistakes that could have been avoided. The more you understand these changes, the more confidence you can have when making decisions about your future. If this information helped you, share this video with someone who is retired or preparing for retirement. A simple conversation today could help someone avoid a costly mistake tomorrow. Subscribe for more updates about Social Security, Medicare, retirement rules, and financial information created specifically for American seniors. Stay informed, protect what you have built, and I'll see you in the next video.